What's going on, everybody? Lawrence here from financialthing.com. Ready for another Thursday peer-to-peer lending and investing live stream. Hope you are doing really well. We have a very special guest this evening, of course. Hold on one second. Hang on. I'm just going to bring him right on to the stream. We're going to get right into it. Hang on one second. It is Yann Murciano from Blend, the CEO. We didn't stand on ceremony today, this evening, Yann. We just get right into it. And thanks for joining us. How are you doing?
Yeah, very good. You?
Yeah, I'm not bad. But it's very warm here in Orlando today. I was thinking it's a little bit too warm, 27 degrees, and feeling a bit balmy. I'm longing for the British weather. Can you imagine anybody actually longs for that? So, how's things in London this evening for you?
Good.
Yeah.
Look here.
Yeah, you're happy.
I'd like to get a bit more sun and sunshine, but otherwise all good.
Well, maybe in the summer you'll get a few days of sun here and there.
Exactly.
Anyway, thanks for hopping on. It's always good. I couldn't believe, I was just telling you earlier, it's been 3 years, I think almost 3 years. It was 2021 in May that you were last here, and it just seems not that long ago. So I wanted to get you back on so we could talk about Blend and just have a chat about the small world that is peer-to-peer lending now at this point. And see what you're going. So, since we last spoke, you had mentioned to me today that things have changed over the last year for Blend. What is going on over there? What some of the things that you've implemented there that have changed that you mentioned?
Yeah, look, change is still the same strategy, but we've closed an equity round probably a year after we spoke. That has allowed us to kind of grow the team, and we took a team from one of the challenger banks in the UK. So we hired the managing director from one of the challenger banks who set up the development finance lending at the bank and built a book to a few £100 million over there. Prior to that, he was a receiver in 2008 till 2014. So he took over the bad debt from the banks on development finance and managed the problems. So that helped us really growing the team and increasing the quality of the deals we're seeing. He joined us with his head of credit portfolio management from the bank and a couple of senior originators from the bank. We saw from when we spoke last time, as we're building the track record, our cost of funding has gone down. We managed to close some institutional funding as well, since when it went down, at some point we were delivering 7% return on the platform because we were increasing the quality of the deals, the rates were going down. And then obviously what's good is interest rates going back up, so it probably managed to now deliver higher returns to the investors. But the quality of the deals has increased significantly since we spoke last time, really.
So you got how big is your staff now over there?
We are 13.
13. I think you've grown a little bit then since
Yeah.
last time we spoke. What is the current size of your loan book over there now?
So we've lent about £70 million purely from the platform. That's excluding what we're doing with the institutions on the side, but that's where we are now.
Okay, so you've grown on that.
Mm-hmm.
And have you seen, so a lot of peer-to-peer lending companies have exited out of the retail space. I saw a piece of news a couple of weeks ago about your institutional credit line that I think it was £50 million, is that correct?
Yep. Mm-hmm.
What is your stance now regarding the institution versus the retail side? Because I think there's definitely pros and cons to both. On the institution line, you kind of got your eggs in this one basket that I would imagine an institution could decide one day, well, I really don't want to give you that line anymore, and you lose that. But on the retail side, you don't quite know how much money you have available to lend out. So what is your stance now with the
Yeah. No,
institutional versus
it's
retail?
a very fair point. It's a key thing in our business model, and I think for those type of platforms, as you said, different source of type of funding you get have pros and cons. The key thing we think is to have diversification. So we still have retail money from restricted investors to high net worth to ultra high net worth, family offices, and institutional capital. So we closed a £50 million facility, which is £50 million to start. We expect as soon as we deploy the 50 million, that's going to double. And in this specific one, new funding line we got, it's actually complementary to what we're doing already, because our background is really to do development finance projects. This funding line we brought is to basically offer more bridging, because what we've seen is the market's been very slow since interest rates gone up. It's improving this year, but the market last year, the sales were slow. So what you tend to see in the market is development projects are finished. You are at the end of your 18 months or 24 months facility. The project is not sold yet or not fully sold yet. Do you keep offering extension to your boards, which is okay, but liquidity wise, obviously, as investors, if you offer a loan for 24 months, you prefer to be repaid within 24 months. So that allows us to carry this project for longer through the bridge. So we offer them a bridge. We exit our development finance on time. We might carry this project for another 12 months. And same thing, we might go to our competitors, take their loans that are expired with this product from the institution, give them a bridge for 12 months, build a relationship with the client, and then offer them a development finance at the end of the day later on, like we used to. So it's just offer more products to the client, to the borrowers today.
So it's kind of the meat with the potatoes. So you've got your retail side and you have your institution side. So there's a bit of a separate product going on. But do you plan to still support the retail side? Is that the goal going forward?
Yeah, look, we spend a lot of time setting up. We went through a lot of work with the regulation. As long as the regulation allows us, which is, to be honest, always a question. I think the market has washed out a lot now. So at some point we had doubts that the FCA will still allow platforms to get these restricted investors. For now, if we can, we would like to. We saw this platform going bust for different reasons. I thought at some point the easiest solution for the FCA was just to shut the door and say, that's it, you cannot do it anymore. Now I would hope most of the washout's been done, and the FCA has kind of really increased the lots and the marketing and the wind down plan and things like that. So you would think the ones that are left are more professionalized, and if they have to wind down, it's better organized. The market is better organized for that than it was a few years ago.
Mm-hmm. So do you think the washout is over of the bad companies? Or?
Definitely a lot has been done. No one's going to argue with that. I don't know. I mean, I'm not invested. I don't see. I don't know what's in the books of those companies. I mean, there's still talks about platforms who have a lot of defaults, right? And I don't know the details, to be honest, to tell you, if you have default and you recover your money, it's not too bad. There's definitely in property a liquidity risk. Like why the banks, one of the reasons why banks don't like this product as well is the struggle is because the treasury is very difficult to manage. You don't know when the money is coming out and you don't know when the money is coming back. So there's that risk. But if the money comes out and it comes back with full interest, capital, and something more when it's late, then it's not bad investment. The question is how they're going to manage these issues, and this I don't know. And I think that's what we said. We said probably last time when we were talking as well recently. I think for investors, the biggest risk is the platform. And when I say the platform, it's how good is the due diligence of your platform. You got to make sure. It's like when you invest in a fund, you got to make sure you invest in a platform that does a proper due diligence and selects the right projects. We don't think it's up to the investors to pick and choose the deals. I mean, they might like some better than others and pick and choose, but the full credit analysis has to be done up front, and the deals that comes on the platform is deals we really back.
Yeah.
That's the key.
I don't think I'm sophisticated enough. As much time as I've spent studying peer-to-peer lending, I personally am not sophisticated enough to select deals in the correct manner, because sometimes the information offered is not really the full picture, and that can be really tricky trying to know what you're doing. I think that's a reason why a lot of people go for the auto invest, because they don't want to have to be responsible for making a wrong decision. Then they trust the platforms to provide them with the correct deals, right? That just doesn't always happen. That's the problem.
100%. I mean, two things. Diversification is key. So using auto lend with an amount to diversify your portfolio, I think, is a good way to do it. Pick and choose the projects you can if you want to, and some people prefer that, and I understand why, and they can. But yeah, I mean, I don't expect some people will have more understanding on our platform than others. Some people like ultra high net worth don't have the time to review deal per deal, and that's why they use our platform. Otherwise, they the bigger guys can do the deals direct. Like they can do a loan of £3 million in one deal themselves, but they rely on our expertise to originate, but to also do the credit analysis, select the right deals, and manage the deals. So you're 100% right. You don't have to have all the expertise, and I'll be honest with you. I mean, I have some expertise on investment from my background, but I don't have all the property expertise, and that's why we brought a team that who have done that for a long time in lending and before that in property, that understand really the risk, and we have we need to have expertise in property and finance. Having expertise in peer-to-peer finance and peer-to-peer lending doesn't make much sense to me, to be honest, because you're not investing in peer-to-peer lending. You're investing on our platform on development finance. So senior lending on property development. Investing in peer-to-peer, it could be car loans, it could be consumer lending, it could be property. So I don't know anyone who has expertise on every asset super well to the details. So it's really about us having expertise on the underlying, on the asset that we invest, on the understanding the boards can deliver the project, understanding the asset. Great if we are 65% or 50% loan to value. It's important, but that's not at all enough. It's making sure the asset is liquid, because I've seen it cases where they said, okay, the asset worth £1 million, we're lending 650K, we're fine, but the asset is really worth £1 million. And if you sell it quickly, does it still worth £1 million or close to that, or much less? And that's where we spend a lot of time. Looking and making sure it's the right projects.
Has the retail side of blends, have you seen more money coming in, or is it about the same? So we spoke back in 2021, it was 3 years ago. Have you been able to attract more on the retail side of investment money? Yeah,
look, again, for fully transparency, we don't spend much money on marketing. I don't think you see us much. The biggest success for us is the word of mouth, where people like our track record. They've been investing, they like it, and that talks the best for us. That's our best marketing, and then we bring other people. Last year, the first quarter of the year, we were pretty quiet as well in the market, so we haven't attracted many investors. And the reason was build costs have exploded, funding costs have gone up. The project we saw did not stack up because valuations we had from Rick's Value, we thought they were too high. People who bought their site paid too much for it. So we thought, look, the property market needs to adjust, and the property market is not volatile like the Bitcoin that I know you like. It takes time to adjust. It doesn't go up 20 or down 30% overnight. It's slow market. So we're patient. We waited, and then from Q4, we had actually a really good quarter in Q4. Actually, our best quarter ever was like Q4 last year, and looks like we're going to replicate this quarter. And the reason was everything stabilized, interest rates stabilized, bill costs now are clearly not going up. If anything, they're probably going to come off, but they've stabilized. So developer came back to the market, and we feel like the market is less competitive than it was. So, and we have a better reputation in the market. We grow our reputation. So we've seen some very, very good opportunities and probably better quality deals than we've seen in the past. So by having more opportunities, we saw more investors coming to the platform to answer your question.
Okay.
Since Q4, we saw quite a lot more investors coming to the platform and new investors.
One of the things that I hear about Blend, because I do like to give people feedback, and from the people that read the Financial Thing website and come on the stream here, is about they're always complaining about the cash drag of not being able to deploy funds, I think, through the auto lend, the way that it's set up. Can you just explain how does the auto lend work exactly? Is it based on who's been in the system longer, or is it just split out evenly? How does that work, and why is there a cash drag difficulty with the auto?
And it's a very good question you have, because that's probably the biggest complaint we got, or complaint, I shouldn't say that, but like dissatisfaction, is people waiting for deals, and we don't agree with it. So two things to explain about the auto lend. It's first to treat customer fairly. It's the same rule for everyone. It's first come, first serve. So if someone have put their auto lend on 4 years ago and never been out of cash since 4 years, they always keep their seats. Every time we have a loan out, you're going to have people who are fully deployed. They put on auto lend maybe for 10 loans or 20 loans. After 20 loans, they're fully deployed. Every time we have loans, so people are out of the auto lend, and then you go up on the queue. You don't have to carry 20 loans on the auto lend. You can have 1 or 2, and every time you get the email, you top up your account. That's the best way to mitigate that and reduce your cash drag. Now, the feedback we had on the cash drag last year was big because there was no many deals on the platform, and on one side you have investors tell you, I want to do deals, I don't have cash drag, I want to deploy, and the other side, everything we're saying is not right. We could get it funded and make money, and the decision was no, we prefer to wait, because this is in volatile environment. Property market can come off 20%, and we thought at some point, I was more bearish on the market than what happened. I think even the equity market, didn't expect the equity market to be at the all-time high so quickly. So we were patient, and we thought better to be patient, do the right thing rather than deploying on the wrong deals. And I think it's been the right strategy to do, because the deals, the project, the opportunities we're seeing today are so much better than what we saw a year ago. So if it's difficult to keep the balance between your cash drag and deploying faster, but our priority, which has been the same thing I've told you last time we spoke, focus on the track records, deploying on the right deals, keeping our track record very strong. And sometimes it's not the right time to deploy, then we'll wait. We'll rather wait. I'd rather do no investment than bad investments. And that's what we've been doing. And look, people say that sometimes they've been waiting and they don't like to wait. I take it, but that's our strategy. That's what we're going to be. If tomorrow market turns and we think it's not the right time to invest, we'll stop. We're always saying, it's not like we stop, it's we're much more picky. So what we had last year is, we see a property, we think the valuation is £900,000 because it's gonna, like, it used to trade at £1 million. Now we think it was 900. The valuation is saying £9 million. We challenge them and we tell them, why do you think it's £1 million? And they tell you, because the last 6 months, the properties, those type of properties have been valued at £1 million. We disagree, because with rates, mortgage rates, when it's at 6.5%, we don't think people are going to pay the same price. We think they're going to offer less. So we say, okay, in that case, we've offered 65% on 900,000 pounds value that we think. So call it 600, 60% maybe on the million pounds that the rigs value are valued. And maybe a competitor are going to do it at 65% because they use just the rigs valuation and they don't do their homework internally. So yeah, I take the feedback, but that's the way we operate, and we think it's the right thing to do.
Regarding the auto loan, is there a cap on what one person's allocation gets, or is it whatever they want? How does that work?
We had times where we had a massive amount on auto lens compared to the deals. We've put a cap. Today there's no cap because today we managed to get opportunities because we had so much more opportunities recently. We managed to get people to fully deploy on auto lend and to be able to lend manually as well.
So if say guy number one in the queue on auto lend has 200,000 in his account, does that entire 200K, if it's available, if he has it set up?
No, because he will say I have 200K on the account, but I just want to put 10,000 pounds per deal. So you'll be in on the next 20 deals, but you barely, except some very small amount of very, very good clients who had the money for all the time seeing auto lend on the top. It changed a lot. We see a lot of people coming out of the auto lend, other people coming in, going back on the queue. Then those guys are fully deployed. The money comes back. They come back on the auto lend, but they're lower on the queue. But at the moment, we have enough capacity to get everyone to invest on auto lend, and plus some people coming to lend manually.
That's good.
It doesn't stay on the platform for a week. I'll be honest with you, but you have the opportunity to invest manually as well.
Okay. What are the returns that investors are seeing currently, percentage-wise?
So currently, 95% of what we're doing now is 10% fixed.
That's a good rate.
We think it's the right price in this market.
Yeah.
If you want to deliver more, you got to take more risk, which we're not comfortable. And when competition today with the challenger banks, that's probably our biggest competition. They're still a bit cheaper than us. We win usually on service and quick on decision making, so we can deliver a bit quicker, in theory. Sometimes we lose against the challenger banks, so we cannot be much more expensive than that. Otherwise, we have to take more risk, and which we don't like. And then being less than that means either we're taking a big spread to the investors or we're mispriced for the risk.
Yeah, and I was looking at your statistics, and hold on. Yeah, I was looking at your statistics. They're pretty impressive as far as the arrears and the defaults. I mean, you just have zero right now, and nothing is in arrears. You've had very, very low projected defaults. How have you been able to keep everything so low when other platforms are kind of struggling in that area, or at least not always struggling, but things tend to run late, and the FCA's definition of default is a little bit different from some platforms, but you've always been able to keep that really in a very manageable position. Yeah, what are you doing differently?
I think we've done 82 projects we funded now on the platform since we started, with multiple loans, obviously, but about project, I think we're close to, the numbers about 82 projects now. We had one default that was during COVID. We had to appoint a receiver. We were at 55% loan to value, and we sold even above the value. So when we sold, we were slightly under 55% loan to value. So we got capital, interest back, everything back. I think there was even some default rate on this one as well. So we were well covered. And I think how we manage the track record is what I've been saying since the beginning is, look, I know our marketing is maybe not the best because we're not spending a huge amount on marketing, but it's all about the credit. And where we behave internally is exactly like a fund, like a credit fund. The quality of people we have, the team we have, is definitely high quality. They understand, they've done it, they've lent hundreds and hundreds of millions, probably over the years, billions. we literally, it's really about the quality of underwriting, and that's the key thing. We had some extensions. We tend to give longer, which sometimes we lose against competitor because of that, but we tend to give longer terms than the borrowers need, because they come, they tell us, oh yeah, we'll build everything in 9 months and we'll sell in 3 months, so we'll be out in 12 months. We don't give them 12. We said, look, if you build and sell in 12 months, good for you, but your 9 months is probably going to be 12, 15 months. And then your sales period, even if you sell a plan, time to get the mortgage and everything, it will take another 3 to 6 months. So we give them longer terms than what they need, because we think that's what fits. If they perform really well, great, they'll repay us early. We committed for 18, we get repay after 12 months, which happened. But I think if you see a big amount of delayed loans, I'm not talking about default, but delayed loans, it's because it's mispriced in the beginning, because they got too many times too short terms compared to what the borrower needs. So that's the first thing. And default is really, again, the due diligence. And this, yeah, our track record, I'm really proud of. And honestly, that's what we've been working crazy hard and growing at the right pace. I think if we want to grow a lot faster, maybe people would have been happy to deploy money quicker and been waiting less, but then we would have taken higher risk, which I don't like. So we had one challenge when I remember starting the business. People saying, okay, you're doing great loans now. Once you're going to grow the business, you're probably going to have to take more risk to deploy more money. And what we've done, pre-rates going up, we actually increased the quality of the deals we're doing compared to the first deals we've done in the beginning, but the rates were going down. So the rates at some point were delivering only 7% on the platform, but that's what we had to do to remain competitive on the good quality deals. As the rates went up, well, the rates went back from 7% up to 10%. I wish it went up 5% like the interest rate in the market, but then you get competition in at 12%. If we want to deliver 12% on the, again, as I said before, on the platform, then you will be taking more risk, which is a risk we don't like.
So do you have any loans that have run over recently, or that are on the platform that have run over by a period of months?
Yeah, we have a couple of extensions now, but those are, I will not consider them non-performing loans, because basically the work is about to be finished. It's not like we have distress with no contractor on site and we need to find a solution. All this is basically planned. I think the challenge you had the most for the developer last year and the year before was bill costs going up, and there was a lot of stress in the market. If you're a lot of small developers, they are the contractors as well. So when bill costs went up, they were in trouble, and we had some that was like, well, my bill cost gone up. When this happened, what do? You tell them to put more money, which is great when they put more money, but realistically, probably 2/3 cannot put more money. They don't have the money. They might have assets, but they're short cash. That's why they come and borrow money at 10-12%, right? Otherwise, they'll be borrowing money. They will not be borrowing money. They will do it with their own cash. So what we've done to make sure we get repaid and on time, one project, we've lent them £3 million. They short £200,000 because the bill cost gone up. We work with family offices that we have a very strong relationship with. They came and they say, okay, we'll lend you the extra £200,000 so you can finish the project. They came ranked behind us mezzanine. They charge more, higher returns, but they take more risk. They don't take the risk that we were ready to take on the platform. They've delivered £200,000. Thanks to those extra £200,000, the developer has managed to finish the project and on time because they haven't slowed down. They got the money. So they were really happy compared to some other lenders who just say, okay, you don't have the money, we're going to default and appoint a receiver. So the developer is really happy. The family office is really happy because they got higher return and they get repaid. And then the investor are happy because they get repaid on time. I don't think they always realized how much work we put into this to get repaid on time, but that's how we spend sometimes a lot more effort to make sure everything gets repaid on time, and that worked out. We've done it a few times. That worked out.
Okay. So can I ask you then, on the statistics page, it says number of projects in arrear is 0. What point, if you said, for example, there is one that is in arrears, does it show up on the website, or is it
We
not?
do it if we don't offer the extension because the loan is not performing. So if a loan doesn't perform, which we had sometime, but it went below 90 days, we say, look, we don't offer you an extension. This you have to repay. If you pass the 90 days of not payment, mispayment of if there's any mispayment and interest for 90 days, we would, which we did in this case on the default, because initially it went in arrears first and then it went to default because they were late probably 180 days by the time. I can't remember if it took 180 days, but we had to, as soon as we appointed the receiver, that was the default. Yeah, and it's about finding a solution and making sure the interest is serviced and everything. So what we've changed as well compared to the past. In the past, when we spoke, every interest was rolled up. Now we service the interest every month.
Okay. So
if the interest is not serviced for 90 days, and that's not a roll-up loan, it's interest on it, that becomes an arrears.
Okay, that makes sense. By the way, do you charge any, or do you get any penalty back from a developer if they run over time? Do you have any penalties for that? And do investors get anything back if a loan does roll late?
Yeah, so we have the option in the loan agreement. We can do it. It's a discretion on the platform. What we do is we will pass 3% to the investors. The balance is to us for the extra work we do, but we do it ranked behind the investor. So first the investor gets repaid capital, interest, and default interest, and then we'll be our penalty rate, and then we're behind. We do it if the developer does not perform. So if the developer has finished and the market's being very slow to sell and we're trying to help them, they've done really well, they've been communicating with us heavily, and we're happy with them, we can take the discretion to say, look, you've done everything right, the market was tough, we waive it. If we think they were underperforming and they could have done better and they're not doing a great job, then we apply it and we pass it to the investors.
Okay.
We share it, basically.
Yeah. It's a little added benefit then, I think, for people.
No, definitely. I mean, it makes sense, I think. But you can feel as well, some lenders will say, I don't want to lend to this guy again. That's why you feel like you should have it. And some will be like, okay, well, he's been late, but he's been great.
Yeah.
I mean, we never had a loan that basically did not pay the full interest. Even if it's late by a month, they will pay the extra months, basically.
You don't want to punish the developer either, because you're trying to support them.
So it's about treating everyone fairly as well.
Yeah.
Like some in this market, forget about the lending through an electronic platform, but like the lending market has a bad reputation because it's not FCA regulated. And I see in the market some bad behaviors, which is interesting. That's why we think the market is inefficient and there's an opportunity in the market. But some people, platforms, lenders, try to make money by applying immediately the default after 3 days, and that's how they make extra money, and that's how they make a lot of money. And look, sometimes you have to, sometimes you don't want to, because it's not fair. You gotta understand why they're late. And if they're late because they haven't performed, then you should. That's what it's there for. But if they perform and the market is tough because mortgage rate went up to 6.5%, then you gotta understand, you gotta give them a bit more time.
You want to support
during
them.
the project. Exactly, during the project, the cost went up, and they've put their own money into the project because they want to make sure it's finished and they want to keep everyone happy. You cannot punish those guys.
Yeah, makes sense. Are you planning on offering an ISA at all, or is that not something you? I know we asked the same question 3 years ago, and you said at that time you would not.
The ISA is a great product. I do get it when people like it. It makes sense. To be honest, we're so busy, don't have time. So we need to get the time to focus on it, to set it up. We always talk about it every year that we want to look into it and get it and do it. Just just been busy. If anyone on your call has ideas to help us, to someone who can do it for us and help us, we'll be very happy to offer it. It's just a question of time. And at the moment, we're seeing more opportunities. And we always, as I said, we always focus on the credit. That's where we spend most of our time.
Yeah, you got to put the
I do
resources
get it.
into what makes you money.
Yeah, look, I do get it. Why it's and that will bring us as well more capital, and it's a good product. It's just didn't have time to focus on that.
Yeah, no, I
I'm
understand.
being too honest, maybe on this call.
Yeah, exactly. So earlier I asked you about the peer-to-peer lending sector in general, which I think has really stagnated in growth, as we haven't seen any new entries into the market for obvious reasons. The FCA is really making it quite difficult. You're still a peer-to-peer lending company at the core. What's your view of the P2P sector, Yann, at the moment?
Oh, my question to you is that does the peer-to-peer sector still really exist? I mean, we
think
don't
so.
even see ourselves. I mean, I think even if you look at the website, we don't really see ourselves as peer-to-peer because we have multiple sources of funding, and lending through the platform for retail is one of our source of funding. We also have like family office funding, which is big with us and great to allow investors to co-invest with bigger accounts, and we have insurance capital. I don't know if there's really little left, I think, in that peer-to-peer compared to what you're. I mean, at some point there was over 100 platforms, right, in the market. Question for you: how many platforms are left? I don't know, but like I would guess not many.
Well, it depends. How many good ones?
What's your guess?
Not many.
I'm not saying the good ones.
Total,
active
total ones, 30 maybe.
Yeah,
If I had to take a guess.
Right. I would have said 20 to maybe 20, but maybe you're right. That's not, I don't know. But look, the sector is definitely smaller. I think for us, the way to succeed is we see ourselves as a private credit platform, focus on real estate. We have diverse source of funding. We need to keep it that way to succeed. And what's great about our private credit platform is retail investors can participate in the deals through the platform. But peer-to-peer sounds almost like a bad word to me these days. I should not say that, but like, yeah, it's not a shining word, right?
No,
talk
it's
about
not.
peer-to-peer lending in 2015. It was, oh wow, it's amazing, it's the future. I think if you're doing just peer-to-peer with just retail money, it's difficult, and it almost stressed me a bit. I mean, one thing we're proud of as well is the due diligence we went through to get this insurance capital. Like, it's through the details that no retail guys are doing on us. It's proper, like, deep due diligence, and that really gives us, I think, a stamp of quality. The risk when you just have retail money is nobody's really looking to the details. So what's behind? I'm not saying it's bad, but it's more difficult to say. So when you say peer-to-peer, yeah, we still want to retail money, but I don't know. Maybe they're gonna be a
resurgence
coming. But yeah, I don't know how many. I remember when I used to read like the P2P Finance News, which has rebranded as well. It tells you about it. It's that peer-to-peer is not really there anymore. There used to be new platform all the time, and FCA approving new platform. I cannot remember, and you'll know better than me, Lorenz, but like, when was the last time we heard the news the FCA had approved a new platform?
I can't remember.
And maybe they're being difficult because the market needs to wash out and has washed out. Hopefully, for the investors who are on different platforms, completely washed out now, and now we only have good one left. I'm hoping that's the case. But the thing, I think peer-to-peer has a bad name now. It's not. When I hear peer-to-peer, it scares me. And when I see the stories of what happened with some of those platforms went down, it's scary. Like, it feels like they were trying to get unsophisticated money to lend at 18% and give 10% to the investors.
Yeah.
And I don't think it was just that. I'm being harsh, but feels like that's been the theme. But when you take insurance capital, you definitely cannot do that, because
Yeah.
They spend a lot more due diligence and they have the experience which some retail investor will have, but you don't have to expect them to have. You see what I mean? Like, so yeah, I don't know what's the future. I'm hoping the market has washed out and there'll be new platform coming that will have to have a proper credit function, like a bank and like a fund.
That doesn't lend
Nothing else
against
exists.
airplanes or something crazy.
No, I mean, I don't know. Even property, look, even property, if you don't do it right, you can get it massively wrong. It's you need, I mean, we have like, three lines of defense like a bank. You need to have a credit arm like in a bank, like in a fund. It's not because you have retail money that you should behave any differently. The deals are the same and they're the same risk that the bank do. So that's the key thing. And I think that was the big mistake initially with those platforms. So I'm not extremely positive about the peer-to-peer sector, but that's what it is, right? I'm not going to tell you, oh, yeah, it's amazing.
Yeah.
I think to us, the future is the great platform is to be able to co-invest with bigger accounts. That's what's great about at least our platform. What we're proud of is you can co-invest with bigger accounts.
That's pretty cool.
And we treat everyone fairly. Like anyone, either family office or retail investors putting a small amount, they get the same rate.
Yeah.
We're treating everyone the same.
How about Blend as a business? So are you making money now? Are you profitable? How's it going?
We're definitely making more money than we spoke last time. Last year was not a great year because we haven't done much for a big part of the year, so we're not profitable yet. We still have a lot of cash because we raised just under £5 million about 2 years ago. But this year we expect to be profitable. A lot of the fees are deferred in our model, right? Because we get an arrangement fee at the beginning, and then most of the fees get paid at the end when the loan is repaid, which in a way, it's our skin in the game to show that we get paid when the loan's repaid rather than get everything up front and then good luck with the loan. So this year, cash on cash, we may not get the profit on the bank yet because a lot of fees will be deferred, but we'll be profitable on an account point of view from what we originate, even if the fees are paid later. Okay. So no, the business has been growing. Business has been growing in the right way. We definitely have a very good team. That's what we're really proud of, and we have now a good reputation with the lenders, at least. With the property developers, and that's what allows us to see better and better quality deals. With investors, I don't know. You tell me.
I think, what I've come to learn throughout my years on this earth is that I can't predict anything because everything I predict tends to go the other way. So I think it's very hard to know what's coming. But I actually think interest rates are going to go back up again.
Back up again?
I do think that.
Wow.
I think the last inflation report that came out of the U.S. It's went back up again. And I think that the U.S. is going to do something really weird with the interest rates to where even if it comes down briefly, I think we will continue to have an inflation problem. The rates will actually go back up again. But I've been wrong so many times. I have a couple of stocks in my portfolio that are negative 50%. So I do get it wrong.
Look, I don't know. Clearly, where I agree with you is the rates. With inflation coming in not as hard as expected, as quickly as expected, you're going to have a flat curve for a bit longer. Rates are not going to go back to zero quickly for sure, and they're going to hold, and it's going to take longer. I think you're going to have a slow cut from the central banks. But I think if the risk is if they put the rates back up or higher or don't cut, you go into a massive recession because you will see unemployment exploding. So I think central banks have, and I'm hoping they will, start cutting. Otherwise, we'll see a big recession. That's my view. So we'll see.
Last week I was looking on the European Central Bank's website, and I found a blog post about Bitcoin on there. I don't know if you saw it, but they were absolutely ripping Bitcoin apart, saying it was a terrible investment. And I'm sitting here scratching my head thinking, imagine if the European Central Bank said Tesla is a terrible investment, or, like how can a central bank put things like that on their website, steering people?
Yeah, that's interesting. Can you share it? I'll be interested.
I can. Yes, I'm gonna put it. I'll email it to you. But it was absolutely just mind blowing. But I did want to ask you a question about, since you being an ex-gold trader, which I find completely fascinating. What is your view if you had to predict for the rest of 2024, which is very hard, I know, because the equity market is so weird. Do you think we're going to end positively at the end of 2024 for the equity market, or are we going to be in the red?
Don't want to give any advice. I don't know how.
No advice.
What it is.
No, it's not financial advice. Just purely a guess.
I think I personally like gold. The biggest challenge with gold. So gold is supposed to be the safe haven. It doesn't really perform as a safe haven, but it performs in last resort. When you had Lehman collapsing, that's why gold exploded. Because if you have a small recession, you don't need gold. You want it really when the market goes up, like it's a safe haven. For me, it's clearly a crisis that's going to come and hit us hard. As we said, like it could be tomorrow, it could be in 15 years. I don't think it's going to be tomorrow, but all these debts from central banks is huge, huge, huge. And the hedge is probably to own gold, you'll say, and Bitcoin. I'm less of a fan of Bitcoin myself, but maybe because I'm emotionally attached to gold from my trading days. And the biggest change you had in the last 12 months on gold is interest rates. When you can get on your dollars, on your pounds, 5% at the bank, how can you hold gold that gives you 0 and probably cost you to carry if you have the physical? So it was very negative for gold. I feel also gold looked really cheap for me for a long time, and one of the reasons was there was no focus on it because everyone was buying Bitcoin. It was like a competitor. Now we're making a new all-time high. Everyone talks about gold again suddenly, and I think it's going to attract capital to it. So I think gold's going to perform. Where it's going to go, I don't know, and I will not say any number because I haven't done any work really on it or any analysis, but I think it's an asset that is going to come in the mind of everyone, that everyone should have a proportion of their portfolio, a small proportion into golds as a hedge, and that would be supportive. And I think people kind of forget about that in the last few years. I mean, last time we really talked about gold was 08, 09. Then as the equity market rallied, no one cared about it. Now people have made cash, the equity market is high. Kind of makes sense to own some downside protection as well. And if you look at inflation adjusted actually on gold, I expect it's very, very cheap. I haven't looked at the chart for a long time, but I expect if you look what the property market did, you look at anything in gold, inflation adjusted, you will see that gold is extremely cheap. So it tells us one thing: it hasn't been a good hedge against inflation for sure. So you don't buy gold because of inflation, but you buy gold, I think, as a safe haven in last resort.
Yeah, it's at 21.58 right now announced.
Correct.
So it's definitely gone up a little bit. What do you think about the equity market? You think that it's going to have we're going to have a good year, or is it just you have no idea?
Again, it's so tough here because you're only close to the all-time high, at least in the US. When honestly last year everyone I spoke to was so bearish, right? And everyone missed it. And now I feel like beginning of the year, everyone felt they missed it. So there's cash around. Everyone's going to go back on the equity market. You have another rally. But then that's why it hits when everyone's long and forget about what we were talking about last year. It's not easy now, I think. I mean, I'll be honest with you, I'm not really invested. I'm not going to sell my book, but I like the risk reward, having 10% secured personally for the risk I like. So I'm personally quite invested on the platform as a personal investment. I I think keep
tough one.
diversification on everything. Keep diversification on everything.
Yeah,
It's
it's a
shocking.
tough
I
one.
mean, the equity market being here with rates going up to so high, you would think that would be a big hit on the US market. And then, but the same thing on expectation and unemployment, right? Everyone thought unemployment, central banks had targets. They thought the unemployment will be higher by now, and it's not. So this market has been very surprising. I don't think anyone called it that easily last year.
No, it always comes back to where do people actually put their money? Property's so high, real stock market's so high, gold is high, and I think people get to this point where they just don't feel like they have much of an alternative other than just stick it in the bank and lose to inflation eventually, or
look, and the
put it
bank
in
now is
equity.
not too bad.
No.
What I like about the property market, if you can get a good yield on it, I don't like the London market. I mean, it's doing better now, but the London market where you get a very low yield on your property if you rent it out. There's not much capital gain, and I think it's a tough product right now. But if your property market is delivering a good yield on a buy-to-let, I don't think it's a bad investment for the long term. There's still a massive shortage of supply of housing in the market, and this we know. And we're clearly not building enough. And you look at last year, last 12 months, construction's definitely gone down a lot because developer was sitting and waiting for things to stabilize before they go into the next project. That's why there was a low amount of new project last year. So as an ex-commodity trader, it's all about supply and demand. While like in commodities, it's easier to measure the supply and the demand. And in the housing markets, I don't see the property markets crushing. And we had mortgages going up to 6.5% at some point. We didn't see prices. There was no transaction for sure. People who had to sell took 5 to 10% discount last year. Now you see a lot of prediction the market is going to go up. I think there was one big one that said 4% up in the next 12 months. Even if it's stabilized, still a good asset. I think it's a good asset to own. Maybe I'm too risk adverse, that's why I don't do the Bitcoin and and a lot of volatile things. But
That's okay.
I think the property market is not bad. I mean, you can feel the sentiment has improved a lot.
Yeah.
And I think now, if you're looking to sell, it will be much easier. If you're looking to buy, it's more difficult than last year already. You do have that. I think so. I think the market has turned a bit already.
Yeah.
People want to negotiate. Like when you have an asking price on the property, people want to get a little bit under. So it takes longer to complete. But there are buyers around now in general.
Mm-hmm. Anything else you want to say about Blend? We've been going for almost an hour, so I said I would only keep you here for 60 minutes.
No, look, if anyone has any question, we're always happy to answer any question. If anyone has any questions online, we definitely think there's a lot more going on the platform this year than last year. So the question you mentioned about the cash drag or the lack of opportunities has definitely changed. And for us, I'm going to repeat myself, and I hope I'll talk to you more before the next 3 years. But like I'll say the same thing is track record, and performance of the book, basically.
Awesome. Well, once again, thank you for taking time out of your busy schedule, Yann. You're always very gracious and kind to come on. We've been
Pleasure.
A friend to the Financial Think family for a long time, so appreciate it. Best of luck with Blend. We'll definitely speak to you within faster than 3 years. And,
sounds good.
If gold goes to 5,000 and Bitcoin goes to 1 million, we'll have another conversation and say, "Wow, look what happened."
You.
You'll say, "Yeah, I'm a genius." But I appreciate it. You have a great evening, Yann.
Thanks,
Take care of yourself. Okay.
Bye.
Bye. So there you have it. There is Yann Murciano from Blend. He always has a lot of insights. He's an ex-gold commodity trader, so I always like to pick his brain about, what he thinks about the equity markets and stock markets and stuff like that. It's always good to get another insight. Just before we go, I wanted to to show you what's going on with the Trading 212 portfolio. We are very, very close. I think we may be at an all-time high actually right now, but we're very close to clipping that £20,000 portfolio. If you look up here at the account value, if you can see it, if you can, 19,787 right now. Really lifted up by Coinbase here. That's now up 84, close to 85%. So really good on that end. Rivian has come back a little bit today. I think it's up 10% last week. We're up quite a bit today too. 13.15% today. So having a good result with the portfolio at the moment. And I've learned a lesson too with this portfolio rather than to let things ride. I've been taking a little bit of profit along the way, as you can see here on March 4th. For better or for worse, I definitely learned from hanging on to things for too long and watching them just plummet to the ground. I feel like Coinbase is very frothy at a high right now, so I sold a couple on March 4th. As you can see here, it was a plus £210 on the result. And then I also sold 4 yesterday for plus £342, so £750 just taken off the table, went into cash. I just don't see any point in letting things really ride on these high-flying stocks anymore. Wish I'd have had that insight with some of the negative ones, but that's the way it is. So right now we have about £7,200 in cash. Really waiting for a pullback actually on this Coinbase stock that I hope will come back into the 170 range. That's my thoughts on it. We'll see if that happens or not, and I'll re-enter that position because I am very long Bitcoin. Obviously, if Bitcoin continues to do well, which it seems to be holding up really well, then these Coinbase stocks should also perform well. Yeah, so 19,786. Doing really well, and super happy about that. We'll be able to make more donations to charity in the future. Anyways, so yes, I hope you enjoyed the Blend Network stream today. Go check them out. You can Google Blend Network. Go check out their platform. They're doing good things over there as far as I can tell. Yann seems to really be, and his team too, they really are offering what I believe to be high quality loans. So anyway, that's going to do it for this evening. I hope you enjoyed the stream. Please subscribe, hit that like button before the stream ends, and I will see you next Thursday, same time, 7:30 p.m. I think the times change next week, if I'm not mistaken. They change on the 10th maybe. So I will be here a little bit later US time, but 7:30 UK time. I'll see you next time. Thanks for tuning in from myself and Harley, who's having a good snooze. We will see you next time.